Well, I guess it's better late than never, is the old saying I can use here. I am back here now with the September update for the Market Bottom series, and it's a tad late this year. We've had a tremendously busy September. We've had lots of friends visiting, lots of family visiting. Very good, enjoyable, fulfilling month. But we're kind of getting back more into the routine now. So this is the continuation of the series I started last year, and it is the 6 indicators I'm following to sort of give us a clue as to what we can expect in the markets. And started back with had the market bottomed at the near the end of last year. In the series, I assess the data. I use history as a guide. And yeah, we can go from there. For those of you who follow us all the time here, you're familiar with the series. By the way, we have launched our newsletter. This is a weekly newsletter I'm putting out. It's called The Pulse. I will put a link in the description of this video if you'd like to follow that and get a weekly update there. So I'll encourage you to sign up for that. Now, as of the last update, which was the end of August, you will recall that we had seen a slight decline in the markets. If we look at the chart here, you can see a little bit choppiness in the month, but at the end of the month, pretty much all of the major indices had dropped slightly. Well, since then, it hasn't been pretty, as we probably are all aware. We see all of the major indices down into negative territory over the month of September, around 4%, 5%-ish, all the way down to almost 7% in the TSX. If we extend that line out to a 1 year, we can see some mixed results there. We see mostly up, but we've seen a bit of a surge starting back in May. We're seeing some pullback, as we've seen recently in those major indices. Now, last update, or actually back in July, in my update, a question I asked at the time was, what would have to happen to see these 4 major indices get back to their lows? I'll throw the table up here, and you can see this column here. It shows the gains that we had seen at the time since the lows of last year, and then the percentage drop that would be needed in order for us to get back to those lows. And so, we're nowhere close to that yet, but you can see, if we look at those major indices since the date I published that table, you can see the drawdown in each of those. So the TSX is kind of actually getting relatively close to what we saw there. The other major indices are down, but not nearly close to there. So I think that's kind of interesting, and it will be interesting to follow those and see where we go from here. But the purpose of this video, what's happening today? So I'm going to start with the first metric that I look at every month. It's called the yield curve, and I do look at the yield curve inversion. What I look at here is the US 10-year versus the US 3-month, and I look at the US 10-year versus the 2-year. The key to this, of course, is that when we have historically seen these yield curves, it's a precursor to a recession. When we see these yield inversions, rather, it's a precursor to a recession. And if we haven't seen those come back up into positive territory yet, at minimum, we could expect to see a correction in the market. But sort of in a worst case scenario, we would go back to those lows we saw last year. So when we looked at this last month, this is the chart that we looked at where we could see both of those yield curves were still quite well into negative territory. Now, a lot has happened over the last month, and the narrowing trend is continuing here. It's a pretty strong move this month. We've seen both of those yields moving back up towards neutral, and at some point, of course, they will again go into positive territory. That's the key here. The yield curves have historically gone positive first, then we see the market bottom. So, I would love to think that we've seen the worst of this, but when I'm just using these metrics, and remember, that's kind of the purpose of this series. It isn't to inject a whole bunch of subjectivity. It's more looking back at history, and these charts will kind of tell us the story. If you are new to the series, if you go right back to the first, there is a playlist showing this, and you go back and it goes into more detail as to historic events and what has happened in these cases here. But with the yield curve inversion, until we get back well into the positive territory, it's a precursor to a recession, a market drop. So I'm going to say these are telling me no. And in fact, even though we've gone back up closer to neutral, that's only confirming that we're no and that the worst is yet to come. Now, when I look at moving averages, that's the second metric here. I look at the S&P 500 versus its 200-day exponential moving average. And with the last update, you can see the blue line here. It had for quite a while, it had sustained itself up above the orange line, which is the moving average. Last couple of times ago, it prompted me with this sustained elevation above that moving average. The fact that it was able to maintain itself there. I'd changed my prediction, if you will, or my assessment to a soft yes, saying, yeah, this looks like we may be in a bull market. Let's look at that today. Well, just the other day, we broke down below that moving average. So the big question now is like, are we going to continue to see a downward trend? It's kind of, if you're a bull, it's kind of disappointing to see that drop below because it is a technical crossover point there. Last month, like I said yes. This month is telling me that maybe not so fast. Maybe we did see a strong bull market and maybe we got a little bit ahead of ourselves there. So if I'm doing this for my own purposes here, I'm changing that back to a maybe. These indicator, my verdicts on each of these will change. It might seem kind of weird. Like if I said last month yes, and this month I'm saying, well, maybe. Well, why did you change your mind? Well, I'm just going by these signals. So again, I'm trying to remove as much subjectivity as possible and just looking at the numbers. So for this month, I'm going to say that we're back into the maybe camp when it comes to this metric. Now, volatility is the next index, and we look at the VIX to measure that. Now, in August, we saw that VIX maintain itself well below that rough average of about 20 over the long term. It was around 14.5 at the time. Well, because of what we've seen recently, not surprisingly, we do see over the past month that there has been a noticeable change upward. Still, nothing, not a spike per se. Still, the market seems quite comfortable with everything out there, but we definitely have seen a change here. Last month, my verdict here was a very, very soft yes. I thought, well, maybe this had been an exception to the rule. Maybe we won't see that spike that we typically have seen. Today, again, I'm not so sure about that. Trying not to let the most recent market volatility influence my decision there, but I think we still need to see that spike. So for this month, I'm just going to leave that as a very, very cautious yes, and I want to see more data in the months to come to see how that might shape my prediction on what's happening here. Now, the fourth metric we use is the U.S. jobless claims, and we're looking for the jobless claims to fall. I mean, these are people who are applying for unemployment insurance, and so we obviously, if there's a lot of people applying there, it's not a good sign for the economy in general. There's been a lot of very conflicting job news coming out of the U.S., but that's for another video. Starting October last year through April of this year, we did see that slow uptick each month. More recently, we've seen a flattening and now a gradual decline. And we can see if we look at the chart today, that gradual decline, almost flat, has continued on the orange line here, which is the U.S. continuing jobless claims. Now, we also look at initial claims. So if we look at August, this is the numbers there. Quite a bit of ups and downs for the case there. Now, starting in September, we do see a noticeable decline in the initial job claims. In the most recent Department of Labor news release, this is what they have to say. They say, in the week ending September 23rd, the advanced figure for seasonally adjusted initial claims was 204,000, an increase of 2,000 from the previous week's revised level. So we did see a slight uptick there. However, when we look at the 4-week moving average, they say the 4-week moving average was 211,000, a decrease of 6,250 from the previous week's revised average. So my interpretation here, we are seeing that relatively flatness of the continuing claims. However, we are seeing on the initial claims, we're seeing that moving average come down. Last month, my verdict was a maybe on this. I do really want to see more of an obvious or a sustained decline on that. Today, I'm going to leave that at a maybe. I'm going to say based on the moving average, we might be seeing this coming down here. And it kind of reminds me that this type of a metric is like a ship turning, not a speedboat, right? It takes a while for the actual pivot to take place. And so for the meantime, we're watching this. I'm seeing, let's see where things go over the next little bit here. So I'm calling that a maybe. Now, the fifth metric that we look at is called the Baltic Dry Index and the BDI. And with the last update, we'll look at the chart from last month. We were still very much trading in a range. Well, since then, there has been a very material change. We can see a very noticeable increase there. Now, what I like to do each month is throw up some of the latest headlines when it comes to this metric. And when we look at last month, the headline was from August the 29th. And the headline was Baltic Dry Index logs worst week in more than 2 months. Well, since then, it has been a whole series of positive headlines. We look at September 13th, the BDI hits over 3-month high. September 15th, BDI logs best week in over 6 months. If we look at September 25th, BDI rises to over 4-month high. And then finally on September the 27th, the BDI scales the 11-month peak. So we really see here what could be the start of a trend. There's some noticeable changes. Now, these are always very fickle, and as always, I like to see more than 1 month of the positive news here. So my verdict last month was a maybe. I'm going to leave that where it is right now. There's some positive signs here. And, as I always say, these are 6 metrics I'm looking, and none of them can be taken in isolation. They all form a picture like pieces of a puzzle. Until you put them together, then you don't really form that picture. So I'm categorizing this as a maybe for this month's report. Now, the 6th metric that we look at is the PMI, Purchasing Managers Index. And this is another inflation-related index, right, or inflation-related metric. And obviously, we want the manufacturing sector to be expanding. And when we look back to last month, we saw the PMI came in at 46.4. That was July. Now, in August, there was a slight tick up. 47.6 is the most recent number that's come out. And this is encouraging. And if we look at the Institute for Supply Management's website, this is what they say. They say the U.S. manufacturing sector contracted in August as the manufacturing PMI registered 47.6%, a 1.2 percentage points higher than the reading of 46.4% back recorded in July. And this is a reminder, even though the number went up, it's still below 50. So it is still signifying a contraction, but just not quite as severe as the previous month. In their commentary, they note that this is the 10th month of contraction and a continuation of the downward trend that began in June of 2022. That trend is reflected in the manufacturing PMI's 12-month average falling to 47.8%. So there is a slight tick up, but another slight decline overall in that moving average. And, I would argue in their commentary here on the term continuation. And yes, there is a continuation of the downward trend in the moving average. However, when we look at this chart, we can see in the last few months, there has been an uptick in the actual manufacturing. So in other words, not quite as bad of a slowdown. So I see that, somewhat as a positive aspect there. However, it is still the 10th straight month of decline. So, I always ask the question, how can that be good? Last month, I asked the question, remember the markets were still pretty hot, and I asked, are the markets reflecting reality? And I wonder, with what we've seen recently, if the answer today is it is. We're seeing here that it's starting to come back to more normal levels, I guess, given all the valuations issues that we have out there, the concentration in what has been moving the markets. And so when it comes to PMI, last month I said no, it's not giving me strong signals yet that we have seen the worst, and my verdict this month continues to be no. So when we look at these in aggregate, the yield curve is telling me no. The moving average is telling me maybe. The VIX, a cautious yes right now. Jobs, maybe. A Baltic Dry Index, maybe. And the PMI is telling me no. So at the end of the day, we have 1 yes, cautious yes as it may be. We have 3 maybes, and we have 2 no's. So what do you think? What is your thoughts? Have the recent market drop, has that affected your opinion on this at all? As I've said for the last year, kind of sadly, I suppose, there's still not enough evidence to convince me that we have in fact seen the worst of it yet. And I recognize that's not necessarily a popular opinion. I'm an investor. I want the markets to go up, but I realize that they don't always go in one direction. As always, please do not rely on this information alone. Use this as an arrow in your quiver as you formulate your investment decisions. A reminder, on Mondays and Wednesdays, I do have a new segment that comes out, so I'd like you to check that out. There's a playlist on our YouTube channel. We have the newsletter Pulse. I will again put the description, or put the link in the description of this video here. I'd love to have you sign up for that, and we can connect with you every weekend. We cover the latest trending business news, and I will put the playlist for that in here as well. As always, I do remind you there is our Investing Academy. I will also put a link for that in the description of this video. So thank you so much for watching this video. I will see you in the next video, and I'll have the next video in this series out before the end of October.